Today is April 3, 1:15 p.m. And we saw some unusual options this morning on Home Depot, ticker symbol HD. So we're going to take a look at that and then propose another trade that requires less capital than the unusual options we saw. So without further ado, let's get into it. Keep in mind, Home Depot is at 296.96, very close to the psychological $300 level, which is right about here, right? Let me mark that in and draw that out. So we are also out of the Bollinger Bands today. These gray dots here are the Bollinger Bands. You'll see here our price is above that now, so the tendency is that it will snap back into the Bollinger Bands. Also, we are overbought on the Williams percent R indicator. This $300 level, you can see that in the past it has acted as a strong resistance here back in the beginning of March, also in the end of February, and back last year in October here, it's also a resistance here, and in September here. So this $300 level is something to keep in mind. It has been very strong resistance in the past. Okay, so let's take a quick look now at the options. Keep in mind, options IV is very low at 5%. So any trades that can take advantage of a low IV would be excellent. And that's actually what our trade was. So these unusual options that we saw was at 10:32 a.m. You'll see here that there was 1,800 and 1,200 contracts all at the same date and strike price. It's the 285s, the puts, and then it's the May 19. Okay, so this totals 3,000 of them together, and let's say they paid about 580, and you'll see here 580 times 3,000 contracts. That's $1.74 million they spent. This amount of capital they had to use to purchase these puts. So that's definitely a large institution with that kind of money. This was the options chain on May 19. This is where their puts were, right here, 285, the 3,000 volume you see here, right? So, but we did not actually buy that same one. We actually sold the 270. You'll see here. And then we took another date out here in June and also bought the 270 over here. So our trade is a calendar spread. It takes advantage of the low IV, so that if there is a pop in IV, an increase in that, we will benefit from that trade. So here's our trade, and let's compare the two so I can learn what is the difference. So this is their trade here. It's a straight 285 strike price put, cost 585. So the reason why we didn't like this trade as much is because the theta is very negative here. It's a negative 10.25 theta trade. So we want to put a trade on it's still a negative delta trade and a positive vega trade, but we don't want a negative theta. So with the calendar spread, you'll see here our trade here is actually a positive theta. It's 1.11, right? And we also still have a positive vega because we believe the volatility will increase, so we want to take advantage of that. And it's still a negative delta trade. So if you want more delta, you can just buy more of this calendar spread. So that's up to you. So with this trade, it's only going for 191, less expensive, but it's also following the same thesis, but with the advantage of with the positive theta trade. And so this is our trade here. And so what we'll probably end up doing is if it crosses 300 and starts breaking that $300 psychological level, we'll probably cut our trade by then, and it's not going to be much of a loss. Okay, so if this is going to play out, the 285 puts, it is going to fall, decrease, and it will fall in our profit zone. And this will actually, our profit will actually be more because the Vega will increase. So for example, let's say it increases, the volatility increases by 10%, right? We add 10% to all of this. You'll see that the profits actually increased more. Our max loss, you'll see here, is at 174 now. It's actually less. We will lose less than the 190. So the increase in volatility, you can switch this around depending on how much that volatility drops or increases to simulate this. The more this volatility increases, the better it is for our calendar spread. So that's really nice to do that, to do a trade that takes advantage of that volatility. And so that's something you can't take into account right away, right now at this moment. And so this is what the trade looks like. So that's sort of what our trade is going to be. And we are in this position already. And yeah, so if you found value in this video, please give us a like, thumbs up, and subscribe, and hit the bell icon, and you'll be notified whenever we see these unusual options. Take care and good luck, everybody.